If you are a small business owner who wants to learn about the income statement, or also referred to as the profit and loss statement, then this video was created for you. Hey there, my name is Brian and I'm the co-founder of Impact Bookkeeping, where we specialize in accounting, financial reporting, and CFO services for small service-based businesses. We created this channel to positively impact the financial future of small business owners across the world. So if you find this information helpful, hit the like button and subscribe to the channel. Alright, let's get started and jump right in. So what is the income statement? The income statement is a report that can be generated after a bookkeeper or accountant has accurately categorized all the business transactions for a specific accounting period. The income statement will take all of those categorized transactions and lay them out into a pretty simple format for business owners to review. It will create a statement that shows the total revenue at the top, minus all of the business expenses underneath, and then the profit or loss for that accounting period at the very bottom. This is why it's also referred to as the profit and loss statement. Along with showing you the profit or loss for a specific time frame, the income statement will also show you a business's gross profit margin and operating profit margin, which are key performance metrics to review. So here's a real income statement for a small business owner who owns a fast casual pizza restaurant. This is a profit and loss statement or an income statement for the month of May. We've got page 1 right here, page 2 right here, and page 3 right here. So at the very beginning of page 1, you've got your total sales, total revenue, total income. And then as we go down, it's going to list all the different expenses that this business incurred during the month of May. And so we've got our cost of goods sold listed out right here. And then we've got a bunch of overhead expenses listed out right here. And then at the very bottom, we have our net profit or net loss. It looks like this business had a net profit of $24,476, which equals a net profit ratio of 23.61%. So that means that out of every dollar of sales or revenue that they get, they're able to put 23.61% of it to their bottom line. Pretty good. Let's take a look at the gross profit margin. The gross profit margin is calculated by taking your revenue, your total revenue, and subtracting it by your cost of goods sold, and then dividing that amount by your revenue. Your cost of goods sold is all of the costs and expenses directly related to the production of the goods or services a business offers, also referred to as direct cost. You will find the cost of goods sold located right under revenue at the top of the income statement. Cost of goods sold does not include the cost or expenses not directly related to the fulfillment of a product or service, such as overhead, sales, or marketing expenses. Now, the higher the cost of goods sold, the lower the business gross profit margin, which isn't a good thing. But that's why being able to review the income statement and see that your business is running a high cost of goods sold is so important. Now that you see it, you can come up with a strategy on how to improve and lower your cost of goods sold, which will ultimately lead to more profit at the bottom of this income statement. So back to the income statement. It said that if we wanted to look at our gross profit margin, we would take our total revenue, which is $103,000, and we would subtract it by our total cost of goods, which is listed right here. That would give us this amount right here, and you would take this and divide it by your total revenue, which would give you 0.50. And if you times it by 100, you would get this percentage right here. So this company, this small business, is running a gross profit margin of 50.39%. Now let's take a look at the operating profit margin, also known as EBIT, earnings before interest and taxes. This is calculated by taking your total revenue and subtracting out your cost of goods sold, and then also subtracting out all of the indirect cost and expenses, sometimes referred to as overhead, and then taking that remaining number and dividing it by your revenue. That will give you your operating profit margin. Now, when it comes to overhead, it's going to include all of the other costs of running the business not associated with cost of goods sold, like rent, salaries, insurance, admin, legal, accounting, marketing, depreciation, and so on. But it will exclude interest and taxes. Once again, in this scenario, the higher your overhead costs and expenses, the lower your operating profit margin will be, which is a bad thing. But that's also why being able to review the income statement and calculate your operating profit margin is so important. Now that you are aware of this and whether your business's operating profit margin is good or bad, you can make strategic decisions inside your business to improve your operating profit margin, which will ultimately lead to more profit at the bottom of the income statement. So what key things can we learn from analyzing the income statement? Number 1, how much revenue or sales was generated? Number 2, which products or services generated this revenue and in what amounts? Number 3, what was the cost of goods sold or the cost of sales? Number 4, what was the gross profit margin? Number 5, what were our overhead expenses? Number 6, what was our operating profit margin? Number 7, what were all of our expenses for this accounting period? Number 8, what was our net profit or net loss? All of these help to tell you how well your business performed for a specific accounting period. What we like to do at Impact Bookkeeping is review the income statement in a month-by-month, side-by-side comparison to see how we are performing over time. For example, are sales trending higher or trending lower? Is our cost of goods increasing or decreasing? Are we making more profit or less profit? Is our electric bill higher in the summer versus in the winter? And so on and so on. As a small business owner, reviewing your income statement on a monthly basis is a must. You need to know how well your business is financially performing so you can make prioritized and strategic decisions about what to work on and improve in the following months to make sure your company stays open and successful. One thing that is not represented on the income statement that is also critical to manage as a small business owner is your cash flow and your cash position. We will soon or have already made a video covering that topic for you. So go find it because that's really important as well. Cash is king, as they say. All right, that's it for today's video. But if you're a small business owner who is interested in outsourcing their bookkeeping and accounting needs, and also wants help in understanding their business's financial performance and how to improve it, please visit our website today, www.impactbookkeeper.com, and schedule an appointment so we can get to know each other and see if we would be a perfect fit for your business. All right, thanks for your time and good luck on your business journey. Take care.